Thank you. Okay, let's begin. Good evening, everybody, and a very warm welcome to you all. Thank you for joining us for another session of the Valorem CXO Meet. My name is Anuj Sonpal, CEO of Valorem Advisors. Today, we are hosting the management of Dhanvarsha Finvest Limited. And on behalf of the company, I would like to thank you all for participating in this event. I would also like to thank the management participating with us today and for giving us this opportunity to host them for the Valorem CXO Meet. So as you already may know by now, the Valorem CXO Meet is a first of its kind virtual analyst meet event series. And our intention with these virtual CXO meets is to take advantage of technology platforms like this by reaching out to a wider audience and to create a better understanding and bring awareness about our client companies' fundamental business, provide insights into their specific industry, financials, and future growth strategies. The format of this analyst meet will be primarily in a Q&A interview format, where I will start off by asking the management some broad level questions and then move on to questions from the participants. Please note that if you would like to ask any questions, you can use the Q&A button at the bottom of your screen to post them there, and I will ask the management these questions on your behalf after I finish the initial broad level questions. Now, before we begin, I'd like to mention a short cautionary statement. Some of the statements made today in today's event may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. Now, let me introduce you to the management participating with us in today's meet. We have with us first Mr. Karan Desai, Joint Managing Director. Mr. Desai brings significant financing and operational experience to the company. He has previously worked with reputed financial institutions, including Bank of America, PwC, and lastly as Head of Corporate Finance at Centrum Capital. He also served as the Chief Operating Officer of a PE fund backed by healthcare services company prior to joining Dhanvarsha. Mr. Desai is a master's degree holder in international business and management from Westminster Business School, London, and a commerce graduate from Narsi Monji College in Mumbai. We also have with us Mr. Rohanjit Singh Juneja, Joint Managing Director. Mr. Juneja is a former investment banker and hedge fund manager with over 17 years of experience in research, strategy, portfolio management, financial analysis, and mergers and acquisitions. He has previously worked with MNC companies like Keefe, Bruyette and Woods, Front Point Partners, Seawolf Capital LLC, WGC Management Services Private Limited. He's also worked on companies in similar sectors located in Australia, Brazil, and Canada. Last but not the least, we have with us Mr. Sanjay Kukreja, Chief Financial Officer. Mr. Kukreja has 27 years of experience in financial planning and control, profit center operations, taxation, and budgeting. He has previously worked as joint CEO in Mascorp and KPL Exports Private Limited, and has also been previously associated with Rotex Wheels Private Limited and Wellspun Group of Companies. He has completed his FCA from the Indian Institute of Chartered Accountants of India. Now, let me begin my first question, which is for Mr. Rohan Juneja. So, Rohan, could you start with giving a brief history and background about the company and the journey so far for our participants joining us for the first time today?
Certainly. Thank you, Anuj. Dhanvarsha Finvest is a technology-enabled financial services company that provides comprehensive credit solutions to the large underbanked and underserved micro, small, medium enterprise sector here in India. We cater towards daily cash flow generating businesses like chemists, convenience stores, cloth traders, shoe retailers, hardware stores, etc. These businesses must generate daily cash flow, and these entrepreneurs must depend on this business to generate a livelihood. We operate in what we call the phygital space, which is a combination of physical infrastructure and strong digital technology. And we aim to leverage technology to make lending faster and more capital efficient with lower risk. We have a highly experienced and independent board. We have 5 independent directors, which include an independent chairperson who's been a former chairman and managing director of a large bank in India. He has over 38 years experience in Indian financial services. We have another gentleman who has been the former head of all cross-border sales and marketing for the Asia Pacific region at Visa Inc. in Singapore, who brings significant experience on the fintech side of the business for us. We have another very seasoned entrepreneur who's on our board as an independent director. We have an esteemed woman director who's been formerly from the Central Board of Direct Taxation. And we also have another seasoned veteran who currently also serves as a security advisor to the RBI. We have recently inducted a very seasoned investor with over 22 years experience in global financial services onto our board as well. This gentleman has recently invested into the company in our most recent equity raise in April 2021. His name is Mr. Porter Collins. He was very famously featured in the book and the movie The Big Short for accurately predicting the global crisis of 2007-2008. The idea behind having such a heavy and independent board is we are very clear that we want to create an institution in the long run, just like you have an HDFC and the Kotak, but we will always stay very true to our core customer, which is the pure play MSME segment. After having started the business in 2017, I think one of the most important times for the company was post September 2018, when there was the IL&FS crisis, which is analogous to the Lehman moment for India. I think post that, the next 15 months was a very difficult time for us. But given the fact that we are small, we're nimble, and we have a very flexible management team who are very enterprising as well, we completely recalibrated strategy, started focusing on the small ticket business loans as opposed to the larger ticket LAP loans that we did in our first year of operations. That helped us significantly. We also incubated the syndication business to survive and stay afloat by generating fee income. The results of all of this were evident 15 months later when HDFC came in as our first lender in January 2018. I think that was a big morale boost for the company, for the board of directors, for the promoter group as well, with having an esteemed lender like HDFC coming in and providing you a line of credit, especially to a company of our size. We multiplied our borrow account by 4x during that time frame, and while the loan book declined, the business had completely bottomed out. So I think that's what gave HDFC comfort. Also, what happened simultaneously is COVID hit. But right when COVID hit, we had the promoter group infuse equity capital into the business, and we were fortunate enough that we got a second line of credit from Bank of India. So a combination of sitting on debt plus equity capital while all the other lenders retreated from the market when COVID hit created a tremendous opportunity for us in a co-lending / FLDG relationship with many other lending entities, which provided us a risk-free way of growing the loan book with a 4 to 5% ROA. So our growth journey started picking up significantly from there. The next few months after that, disbursements grew very nicely. The loan book started growing fairly well too, with very, very little risk. And I think State Bank of India then coming in as our third lender in the month of October 2020 really started getting the ball rolling. It was a difficult one to get for us because it took a lot of time for State Bank of India to materialize. But nevertheless, having a large lender like State Bank of India believe in you was a big moment for the company too. Post that, the promoter group, along with the key management, infused capital into the business in November 2020. That also got the ball rolling for us in a much bigger way. The January quarter post that, we had a disbursement quarter of almost 400 million rupees, which was the largest ever disbursement quarter in the company's history. We added 9 new lenders onto our lending roster, and in February 2021, then we announced another equity infusion, which was led by prominent investors like Porter Collins and Vincent Daniel, who again, are part of the book and the movie The Big Short for accurately predicting the 2007 housing crisis in the US and the ensuing global crisis post that. Having these kind of investors believe in our story and having spoken to them for more than 18 months and them finally investing was a very important event for the company. It gave employees, it gave management, it gave board, it gave the promoter group a lot of confidence. We at Dhanvarsha, most of us are fairly entrepreneurial and ownership oriented. There's a heavy ESOP program that the board and the promoter group has set up for management. And that's our journey so far. It's been a fairly interesting one, and there are a lot more interesting things to come for us in the future.
Okay, thanks for that, Rohan. And let me ask you a follow-up question. You talked a little bit about the whole ILNFS crisis, and if that wasn't bad enough, then we got hit by the COVID pandemic, which made things worse. And within this, there is a perception that the MSME sector has been hit the hardest too. So could you give our participants your outlook on how the sector is evolving and where it is heading, the NBFC sector? And with that, also talk to us about a little bit about, the differentiation that DFL brings, and, the management's vision for DFL.
Certainly. So I think I'll start off by saying that it's a very interesting time in terms of where we are in the industry today. As Mark Twain has famously said, history doesn't repeat itself, but it often rhymes. I think one of the most important lessons that all of us need to remember is that at the end of the day, no matter how tech enabled a lending business is, we still are a lending business. So history has taught us from prior cycles that oftentimes when the times are very good, money is easy, a lot of firms take on excessive debt without actually realizing the consequent events that will follow when the cycle turns. And that's exactly what we saw in India in the late 90s. That's exactly what we saw in the US in 2005 to 2008. And the period after that was actually an even more interesting time because very similar to what happened in India post IL&FS, for the next 2 years after that, lending became very, very difficult. A lot of players in the NBFC space, especially, and some of the banks too, had to pull back on lending because they had to clean up on the asset side of their balance sheet. I think today we're at a very similar time compared to what India was in 2001 to 2004, where the US was from 2011 to 2014, where you had a whole new crop of small, innovative, and nimble players that cropped up with new business ideas that were able enough then to generate significant scale with a lot of profitability because competition was much lower. So we feel we're at a very similar time like that. We've been through many cycles as part of the management team over here. Dhanvarsha, our head of credit, has over 32 years of experience in Indian banking. Our CFO, Mr. Kukreja, who's on the call as well, has been part of the finance and accounts industry for over 27 years. Our head of collections has been a veteran in collections and recoveries, along with being a lawyer for over 20 years. We hire employees who have a very entrepreneurial mindset. People over here who are employed at the company have run their own healthcare business, have run their own auto business. So, and we also have a very young and energetic fintech team who's seen cycles not just in India, but also in the US and elsewhere. So what we ended up doing at Dhanvarsha, we realized that it's very important to build a traditional lending business first and then marry it with technology, which is what we are putting a significant amount of time and effort on, that Karan will elaborate. I think the key to differentiate ourselves and the key to succeed in this industry depend on a few things. The first one being good corporate governance, which we pride ourselves on. The second one being focusing on consistent and sustainable growth across market cycles, because there will be cycles with ups and downs. The third one being prudent credit underwriting policies with a very strong collection backbone. Number four, diverse revenue streams. And number five being management having an innate sense of capital allocation. For us, we feel these five qualities have actually helped us significantly in the last 4 years of us being in business. We have not just withstood the IL&FS moment, which is the analogous of India's Lehman moment, but we've also thrived despite the two waves of COVID. Given the fact that we focus on daily cash flow generating businesses, COVID actually was not as negatively impactful for us. In the first lockdown in April 2020, we granted a moratorium to about 24% of our borrowers. Importantly, post the moratorium being lifted in September 2020, more than 90% of those borrowers who availed a moratorium actually paid back all their dues on time. I think there are two very important differentiators for Dhanvarsha and something that we pride ourselves on. The first one being that we actually enable businesses, and we have a very strong partnership ecosystem that we enable for these businesses. So we've tied up with several firms across multiple segments that fit our borrower profile. The simplest example that we can give you is we enable a lot of these businesses with an expense management solution, with an inventory management solution that enable them do business in a much easier manner, and that also help us monitor their repayment behavior, monitor how well their business is doing. In today's world, our firm belief is it's a world of collaboration rather than competing with each other. You have to collaborate with each other to make sure that both businesses are successful and the borrower and consumer at the end wins. And for that, we have to leverage on each other's strengths. So we have done that very successfully in our co-lending relationships where Dhanvarsha gets a first loss default guarantee, in our co-lending relationships with larger lenders where we are the minority lender, but we make money on the money that they disperse as well. We are the sourcing, servicing, and the collection provider on those loans. And we've done that very well with our lending partners as well, where for a small company like ours, we have esteemed lenders like HDFC, SBI, Bank of India, Central Bank of India, NABARD, two foreign lenders that have given us an NCD, Mass Financial, Northern Arc, AK Capital. The second big differentiator for us is the fact that we have a phygital model, which is a combination of low capex physical presence, along with having a very strong digital presence. While both these models in isolation have their own merits and demerits, but what this does for us is it's a very important diversification tool where we don't get wiped out in the case of any exogenous event. Our firm belief is financial services, especially enabled with technology, while people do take risk and it's a business of taking risk, what's most important is how you mitigate risk. So that is another big differentiator that we pride ourselves on.
Sure. Thanks. Thanks for that. It was very insightful, Rohan. Let's move on to Mr. Karan Desai for my next question. Karan, to start with, if you could educate our participants on our different product offerings, and we've been aggressively, I see that, expanding our branch network. So could you also tell us a little bit about your distribution channels, our collaborations, and also the future growth strategy on this mix, and also maybe touch upon the AUM dispersals and lending mix while you talk about this as well, please.
Sure. Thank you very much, Anuj. Good afternoon to all the participants. So to give you a quick context, Dhanvarsha today offers a highly diversified and highly secure product environment to its MSME clientele. We have a multi-pronged sourcing approach, which includes close to 30 branches, 400 financial inclusion store partners, our very own digital platform, FLDG-backed sourcing relationships, and last but not the least, our DSA and other channel partners as well. To give you a context, the mix for August 2021 was a disbursement of about rupees 436 million or 43.6 crores, which was broadly sourced across 60% from our branches, 19% from our FLDG-backed partners, whereas the channel partners and financial store-driven contribution was about 18%. And a small but slowly increasing component of our sourcing today comes from digital, which is at about 3% of the overall business at this point in time. We are confident of being able to sweat this existing infrastructure, which when coupled with the constant infusion of tech enablers, which I will elaborate on shortly, will allow us to hit steady state run rates of 60 crores plus per month without any incremental or significant capex or opex. To give you all a quick rundown on the products that we offer currently, I'll take the gold loans or the MSME gold loan segment first. These can be classified as very small ticket MSME loans, which are secured by the collateral of gold. Some important points to note here is that while we started this business only last year in the month, actually at the tail end of August 2020, the assets under management here are already rupees 700 million or 70 crores plus. The average ticket size on this book is barely 120,000 rupees at this point in time. The effective LTV or loan to value on the portfolio is less than 60% when you adjust it for jewelry making charges. This, when coupled with yields of about 20% per annum with paper loan tenors of 12 months and a typical rollover of about 4 months, make it an extremely attractive product. An increasing chunk of this portfolio now qualifies for priority sector lending. By the end of September, we will be present across almost 30 branches in 5 states of India. And the MSME gold loans product today accounts for about 50 to 60% of our monthly disbursement. Second, the MSME business loans product. And these are typically small ticket working capital loans and are provided to micro and small business enterprises within the broader construct of the MSME segment. The AUM of this product is about rupees 600 million or 60 crores at this point in time. Average ticket size on the book is about 400,000 rupees. While the product is unsecured, but we follow very strong recovery mechanisms using legal tools, especially Section 17 of the Arbitration Act. In fact, 50% of such disbursement each month is now secured by cash FLDG or first loss default guarantees, which are provided by our sourcing partners. This today is a 0% NPA sourced model for us. 100% of these loans qualify for priority sector, considering that the ticket size is below 20 lakhs. The yield on this book is about 24%, with an average tenure of about 24 to 36 months. Today, this business accounts for about 30 to 35% of our monthly run rate. Last but not the least, we also do small ticket personal loans, which are essentially provided to salaried customers. The AUM of this book is about rupees 300 million or 30 crores at this point in time, with an average ticket size of about 150,000 rupees. While these are unsecured loans, but we enjoy extremely high collections efficiency on this portfolio. 50% of such disbursement each month is also secured by cash FLDG through sourcing partners. And once again, this sub-segment of the book is a zero NPA book at this point in time. Here, the average yield is about 22% and the average tenor ranging from 36 to 48 months. This product accounts for about 15 to 20% of our monthly disbursement at this point in time. To wrap up on the product side, I think what I'd like to essentially say is that as a business, we are fairly clear now about the segments that we wish to fund, which is typically, as Rohan also mentioned, the small cash and carry businessman and the small salaried customer, with a focus on securing these loans via the collateral of gold or cash funded guarantees via sourcing partners to the maximum extent possible, which on a monthly run rate at this point in time is well north of about 70-75% of our monthly throughput. We are one of the very few institutions in our space where the quality of asset portfolio is improving as we hit more and more scale. We have a strong conviction that the multi-pronged sourcing model, which includes branches, guarantee providing partners, our channel partners, and our digital sourcing channels, will hold us in good stead through any market cycles. Last but not the least, the 4 C's, which is what we live by: credit, collections, capital, and collaborations, truly form the bedrock of our business.
Thanks, Karan. So another, maybe let's take a follow-up for you. I've seen that we are using a lot of tech platforms, and Rohan, and you also touched upon that. We're using this for our proprietary lending and also risk mitigation purposes. And apart from that, we have also launched a platform called Money Rabbit, which is DFL's omni-channel digital lending platform. So can you educate our participants about these about the whole use of fintech and what are we doing here?
Sure. So we'd like to kind of classify our technology story into 2 parts. One is, of course, Dhanvarsha One, where we've always had some element of technology empowering our business through digital loan origination management systems, a small consumer lending platform, so on and so forth. But at this point in time, I'd like to share with everyone that we are currently working on 4 large projects on the tech side, for which we are leveraging the combined strength of not only a full stack in-house tech team, which we built over the last 12 to 15 months, but are also working with the country's leading digital transformation consultant and top-notch vendors for the development needs. So I'll try and take you all through each of these projects one at a time. So as you mentioned, Money Rabbit, let me begin with that first. So Money Rabbit is being built to be a micro-lending platform to cater to MSMEs and small borrowers. This, just as a disclaimer, will not be a typical payday loan platform offering money at loan shark rates. It will be a platform which will allow small customers to avail of small ticket loans at fairly decent rates of borrowing. And it will be completely alternate data driven with a focus on educating borrowers on their credit health. The USP of this platform will be a subscription driven credit health assessment model, wherein we'll be working closely with one of the country's leading credit bureaus to educate customers on their current credit health situation in a very simplified, gamified, and vernacular manner. The micro loans will be disbursed in under 5 minutes using completely alternate driven data, which has been built in-house by our team from scratch. We propose to use MoneyRabbit for treasury management, and eventually, once the prototype and the risk testing is complete, we will eventually also allow other lenders to lend on the platform along with us on a risk sharing model. This is on MoneyRabbit. The second big B2C platform that we will be launching is the Dhanvarsha Neobank. This will essentially be the front-end B2C phase for our traditional business and will be wrapped around the company's loan product suite. For this project, we are tying up currently with one of the country's largest private banks, which is one of the technology leaders in the space as well. Unlike a lot of other neobanks, we foresee that our cost of customer acquisition, or CAC, will be extremely low, given that we will acquire customers even for the banking suite with our core offering of loan products. Starting with the savings account, we will also eventually move on to current accounts and hence be one of the few neobanks which will offer services not just to salaried customers, but to MSME current account holders as well. The third is the Dhanvarsha lead generation platform, which is already live as we speak. It is a web-enabled platform to generate digital leads for its core business. The contribution of this in our internal disbursements is slowly increasing month after month. It is now also powered by a credit bureau integration and DREs to curate the quality of leads and improve convertibility of clients. The longer term plan is to make this a single platform to offer a marketplace-like experience to customers who might want to avail of not just loans, but several other financial products as well. These will be the three front-facing consumer assets, which will be powered by a fully integrated loan origination and management system in the backend. As we speak, phase one, which is the personal loan deployment, has gone live on the 1st of September. We are working with a leading vendor who offers a state-of-the-art, fully integrated LOMS to migrate our existing PL, BL, and in the next 2 months, GL product onto the platform as well. While the initial launch is complete, we expect the full stack to be live by November 2021, thereby substantially improving our turnaround times, reducing risk, enhancing productivity, and improving the quality of reporting as well. So those are some of the big initiatives on the tech side, Anuj.
Thanks a lot, Karan. Now, before I take questions from the participants, I have one final question for Rohan, and then we'll take questions from the participants. Just a reminder, participants, if you have any questions, please use the Q&A button at the bottom of your screen, and I will ask those questions on your behalf to the management. So, Rohan, circling back to you, one final question from my side is, so, we've managed to considerably improve our GNPAs in the last 2 years, even with the effect of COVID. Apart from this, we've also managed to grow well and maintain our balance sheet strength. So could you explain the strategy on how we made this possible, and also talk a little bit about your liability side of the balance sheet?
Certainly, Anuj. So I think a few things have helped us over here. One is, in our first year of business from September 2017 until September 2018, we only wrote business in the LAP product. I think the recalibration of strategy to defocus on LAP and to write smaller ticket business loans towards daily cash flow generating businesses, what we call the essential goods sector, that was a big contributor towards the decline in gross NPAs. What happens with certain high ticket LAP loans is a few of them going bad create a big spike in your NPAs. So by debasing that, by increasing your borrower base significantly, we've gone from a borrower base of 135 borrowers in September 2018 to over 20,000 borrowers today. That helps reduce the severity of the losses. So that has helped us significantly. I think it's also important to mention that while our gross NPAs have gone down significantly to about 2.87% and net NPAs are below 1%, 81% of our gross NPAs still come from 7 LAP loans that were originated between September 2017 and September 2018. We're fairly confident of recovering on these loans, and we should see good traction on that over the next 6 to 9 months. So that's point one. The second point on the balance sheet strength is we put a lot of emphasis and focus on really having a very strong liability side of the balance sheet and relationships with lenders. So just to give everyone an example, it took 9 months for a State Bank of India loan to materialize, right? It was a constant effort. educating them on how we do business, why we do the business in the manner in which we do it. So that has resulted in significant benefits for us, for a company of our size to have 13 lenders. Again, the kind of lenders that we have, including HDFC, SBI, Bank of India, NABARD, two foreign lenders, DCB Bank. It's a big achievement for a company of our size. Number three is, even when we started growing, during COVID and post-COVID, it was largely growth in the gold loan backed sector. So MSME loans which are backed by gold, and also business loans which are backed by a first loss default guarantee. I think that's very, very important. It goes to show about the strong partnership ecosystem that we have developed at Dhanvarsha, and the need to grow in a very risk mitigated manner, because lending is an extremely responsible business. So a combination of these things have really led to us, growing well, keeping our gross NPAs and asset quality in check despite COVID. And in COVID times as well, our borrowers, knock on wood, have been open because they belong to the daily cash flow segment. Last but not the least, also the fact that we've raised equity 2 times in the last 1 year. So we had a equity round in November 2020, where the promoter group and key management infused capital into the business. We raised equity recently in April 2021 as well, to further bolster the balance sheet, keep our capital adequacy high, so that we can keep dispersing at a good clip.
Thanks, Rohan. So let's move on to questions now from the participants. Again, as a reminder, participants, if you have a question, use the Q&A button at the bottom of your screen. So let me take the first question from Parthiv Jonsa. He's asking that now, with international reputed names associated with the company, how can we plan to scale up the operations, the AUM, margins, and what is your understanding how this will grow over the next 2 to 3 years?
Sure. So, we've had a very interesting journey. It's taken us 4 years to go from zero to about 2 billion rupees in AUM. I think the next 4 years, we'll see significantly faster traction in our loan book. That is largely due to the strength on the liability side of our balance sheet. Our leverage is still very low today, with the debt to equity of 0.7x. Obviously, the idea now is to start levering up the balance sheet further and grow at a run rate of about 40 crores a month, or 400 million rupees a month, here on, which we've done in the last few months. In terms of margins, our margin in the most recent quarter was slightly lower at about 5.3%. The only reason for that being we carried a heavy investment portfolio with the equity raise that got concluded in April. But otherwise, we strive for a margin of between 7 to 8%. So in terms of AUM growth and margins, we should see fairly healthy numbers on both those fronts going forward.
Okay. His follow-up question from him is that in the next 12 months, what will be the breakup of AUM between different verticals, such as personal, gold, and so on? Any target number or mix here that you'll have in mind?
So at this point in time, the breakup of our portfolio is about 37% of the loans are backed by gold, 33% are business loans, of which more than half of them are backed by a first loss default guarantee. 18% are LAP, and about 12% are personal loans. Again, a good amount of the personal loans are also backed by a first loss default guarantee. Our endeavor is that gold loans should be between 50 to 60% of our loan book over the next 12 to 18 months. We will be strategically running off the LAP portfolio, because that is not a product that we want to write on our own balance sheet. But the idea is to build a more secured book backed by gold and FLDG over the next 2 to 3 years.
Sure. Thanks. Next question we'll take from Sneha Ganatra. She's asking, on the liability side, which are the key avenues we are now focusing on, and what's the current rating and the incremental cost of funds?
Sure. So on the liability side of the balance sheet, the predominant lending that we have availed of from our lenders today has been term loans. So we've taken out term loans which are anywhere from 2 to 5 years in duration. With the PSU banks, they're usually 48 to 60-month loans, so 4 to 5 year loans. With the private lenders and the banks and the NBFCs, it's usually between 1.5 to 3 years. We've also done two very successful gold bond issuances. One of them got concluded yesterday, which was subscribed 100% on the first day itself. The first one that we did was on the 9th of June, which was subscribed to 100% as well in the first 1 hour of its launch. So the what we will continue to do is we will use a mix of term loans, NCDs, and these gold bond issuances over the next 12 to 18 months. We do not plan to issue any CPs at this point in time, given the fact that we want to match the duration of the assets with the liabilities. Our incremental cost of funds are below 12% today, so they have come down over the last 12 months. Our rating is triple B by CARE, and we got upgraded as well by Infomedics, which was a triple B minus to a triple B in the month of March.
Sure, thank you. Participants, if you have any questions, please use you can ask your question on the Q&A button. Let me take some pre-registered questions at this point, which were asked before the meeting. So one question is that y'all are planning to launch Money Rabbit. So will there be any kind of a shift in the way we lend in the future? And also that, the world is moving towards tech lending, but we have a hybrid or a phygital model, as we say. So what is our thought process here?
Sure. So we really like the word phygital because it's kind of a marriage of both the worlds. We started as a very, very traditional lender with practically, less than 10% technology intervention in any of the business that we did. Come a long way since then, and we strongly believe in the power of technology to be able to revolutionize the business on multiple fronts, be it, risk management, enhance scale, being able to reach customers that we could not reach through our branches, and at the same time ensuring that we can lower our operating costs as well. So from that standpoint, tech will be a very large part of the investment that we do going forward. Talking about Money Rabbit in particular, we aren't launching it as a payday platform. So essentially, this platform will be provided to a very similar customer base that we already service, which is a small MSME or micro enterprise client and a small salaried customer as well. These are people who might have short-term cash flow mismatches of maybe 5, 10, 20,000 rupees for a week, 10 days, whatever it might be. And we aim to fill that gap by providing fast money at an affordable cost with a very elaborate focus on educating them on credit health. I think that is the most important element of this platform. And, from our perspective, we will, of course, put the power of our balance sheet behind this platform. But beyond a point, maybe 2 or 3 quarters of the platform being live, we would like to invite participation by other lenders to come co-lend with us on this on the basis of some risk sharing models. So, going back to the 4 C's and focusing on collaboration, we would love to do this business with other lenders like we do in our current traditional setup as well. So essentially, to conclude, tech will be an extension of our existing way of doing business.
Thanks, Karan. Next question is from Giriraj Daga. How will the sourcing mix look like in 2-3 years down the line?
Okay, so from the sourcing perspective, when we started the company and for the first 2.5 years, practically 90% plus of our business came straight from the DSAs. Whereas if you take into account just the last month's mix, almost 60% came from our very own branches with no customer acquisition cost. Barely 10 or 15% of the business came from the DSAs, and the balance came from our FLDG partners, again, where the cost of acquisition for customers was practically non-existent, which is why even to stitch this back to the tech story, we are extremely confident of doing well with our tech platform. So the simple reason that the cost of acquiring customers, which is the principal killer in any new digital B2C customer asset, will be a lot more manageable for us through this hybrid model that we follow. So long story short, DSA sourcing will continue to dwindle in our business, and beyond a point, maybe 2-3 quarters out, we want it to be less than 10%, up to 60% from our own branches, increasing sourcing from digital feeding this vertical as well. And last but not the least, about 20-30% coming from our FLDG backed partners, where cost of client acquisition again is zero for us.
Thanks. His follow-up question is, what is the average ticket size on the gold loans, and how are we competing with other banks in this, given that the last 2 years banks have become more aggressive on giving gold loans?
Sure. So the average ticket size on our gold book today is just shy of about 125,000 rupees, which is 1.25 lakhs. It is constantly reducing as the size of the portfolio increases. And as far as competition is concerned, we principally compete with the larger NBFCs, Muthoot, Mannapurams, IIFLs, etc. of this world, and not so much with the banks, for the simple reason that the time that we take to turn around a loan, which is about 30 minutes right now, is not a time frame within which the banks will typically fund the customer. So while there is a significant rate differential between the rate at which we provide money and that at which the banks do, the customer segment is completely different. They will only fund their existing clientele, whereas as far as we are concerned, if the gold is good, the customer KYC is fine, we would be happy to service him or her in 30 minutes flat.
Thanks. Next question is from Sanket Bihani. How do you differentiate yourself from other lenders or fintech platforms? I think this is something you touched upon, but maybe if you could really elaborate on it.
Sure. So I think we would not call ourselves or classify ourselves as a pure play fintech company or aspiring to be a fintech company. We are a company that has a strong focus on three core products, which is gold loans, personal loans, and business loans. Within personal loans, of course, now with the digital lending platform, we will get into the micro personal loan segment as well. These are extensions of the products we already do, catering to the same customers that we've been funding for over 4 years now. Is just a new method of reaching out to them, offering them a slightly different product. So from that standpoint, we think we are well positioned and uniquely positioned in the market to acquire these customers at very low cost and be able to underwrite their risk much better than some of the probably new age fintechs, where the understanding of credit might not be as strong as the expertise that we've built over the last 4 years.
I think there are certain other nuances also, Anuj, that one needs to understand, right? At the end of the day, it's a lending business. So, while we also today, we have over 20,000 customers, over the next 2 to 3 years, we will have significantly more customers powered by technology, but certain nuances in the lending business that probably not all fintech players understand and appreciate as much. So what we did, like we spoke about earlier, is built a traditional lending business. We hired people who understood the lending business to start with us in 2017 and then married it with technology. So simple things like even signing a demand promissory note, right? Without doing that, you can't go after the customer from a litigation standpoint, which, it's very easy to distribute money, to lend money. But as a lender, you're only as good as collecting on your money on time, every time. So, while technology is a great enabler, at the same time, one needs to be very careful as well, especially with the segment that you're lending to.
Sure. Thanks. Next question from CG Philip is, what differentiates us from other MSME lenders? What are the risk mitigation measures to address inherent volatility in the MSME segment? What was the COVID impact on our books in terms of collection efficiencies and disbursement trends?
Sure. So I think, we had our learnings as well in our first year of doing business, especially while we cater towards the MSME segment. The product that we lend to them with, which was essentially loan against property or home equity, was not the ideal product for us, right? It's a very long gestation product. It creates asset liability mismatches in your book. So what differentiated us was we consciously, took a call to focus on the essential good segment. So, daily cash flow generating businesses where you really need to get your hands dirty in how to lend to them, right? So it's very apparent why people want to lend to them, because it's a lucrative segment, but how one lends to them and how one collects from them is a different ballgame altogether. So that differentiated us. I think we put a significant amount of muscle in doing that, right? Hiring the right team who's done that in their previous organizations, building out the tech platform to cater towards these customers, helping them tie up with expense management solutions, inventory management solutions, which many of them were not oriented with in the past, right? Also enabling them with many other financial products that they weren't acquainted with. So for instance, helping tie up with mutual funds that actually cater towards a product towards this customer. Also identifying what it takes for this customer to put their kid through school, right? So can we also offer them a personal loan product and kind of mitigate ourselves from a risk standpoint? Then we also learned along the way that it's much easier for this borrower to give us gold as collateral as opposed to giving us what they call in India dukan or makan, right? Either your house or your store. They don't want to give that as collateral to you, but it's much easier for them to give you gold as collateral. So taking gold as collateral where they come and redeem it before the tenure of the loan runs out. So that promotes good asset quality and it also enables good churn on our capital, right? So a combination of all these things has helped us differentiate ourselves in the market. I think that's also fairly apparent in the performance in the last 18 months, where in March 2020, we had 403 borrowers. Today, we have 20 plus thousand borrowers. At that point in time, we had one lender. I think lenders are also starting to appreciate that distinction in our business model, where we went from one lender in March 2020 to over 13 lenders today. We've taken our net worth up 5x. Equity investors also, have believed in what we're creating. So we feel that it's still very early innings in our growth journey. We have just actually gotten started now. There'll be a lot more, especially on the tech part, that we differentiate ourselves on, be it the credit builder platform, be it the neo bank, that we will enable these customers and these business owners with going forward.
Great. Thanks, Ron. Next question, another follow-up from Giriraj Daga is, what is our outlook on branch opening and what is the gestation period on the branch break-even levels?
So on the branch openings, just to give you a perspective, March ending, we were about 16 experiential centers, as we like to call them. We will close September at 30 plus. And the idea, at least for the next 2 quarters, which is the December and March ending quarters, is to at least continue opening at the rate of about 2 to 3 units a month. Now, these give us significant brand presence on the ground. And in parallel to the branches that we are opening, just to share with everyone, we are also setting up, or rather rebranding, a lot of small cash and carry stores at Dhanvarsha stores across the markets where we operate. So these are typically converting small businesses into channel partners for Dhanvarsha, wherein they will source clientele for our loans and, of course, cross-sell other products like insurance, etc., to their customer base as well. As we speak, we started this business or this endeavor in the middle of May 2021. We are already 400 stores plus in the state of Maharashtra, and our effort will be to take this to about 1,000 plus units by the end of March 22. This again becomes a fairly unique and differentiated sourcing channel for us and allows us to cater to small clients in places in Maharashtra or the interiors and other states where we probably wouldn't even have a branch of our own. All these clients are being serviced digitally, wherein the personal discussion, which is the PD, is being done on video. Agreements are being signed through API channel partner tie-ups. So a lot of this business is currently also getting executed digitally. And once our new systems launch, we are confident of being able to take them up to scale. As far as break-even is concerned, typically an experiential center has an OPEX break-even at an AUM of about 2.25 to 2.5 crores, assuming a staffing of about 4 people. If you take a tier 2 city in India, the typical throughput per month is about 40 to 50 lakhs or 4 to 5 million rupees of monthly disbursement. So you can hit OPEX break even in about 6 months of time on a steady state basis. If you add the supervisory costs, you probably will need to do double of that. So in a year, the branch will not only cover its OPEX, but also supervisory costs. Post that, it starts accreting ROA for you.
Wow, that's impressive. Next question from Dubirex is, can we share the cost of acquisition per customer and how it has progressed over the last year?
Sure. So to give you a perspective, I mean, considering that we stopped writing LAP a while ago, which was a secured loan, so the cost of acquiring a LAP customer would be, typically about 1%. You would charge the client about 1.2%. So we gave you a net earning just on proc fee of about 20 basis points. When you move this to the unsecured realm of business loans and personal loans, if these were largely DSA sourced, then your cost of acquiring that client would be anywhere in the range of 2.5%, and the proc fee that you collected would be almost the same. So at a net level, you broke even. But the beauty of how our model has evolved now is that at a branch level, we spend a pittance on marketing right now. A lot of it is done through word of mouth. So the cost of acquiring the customer at a marketing level is extremely low now. We would say it would be less than about 0.2% on a per loan basis. As far as the FLDG partners, again, which constitute almost 20 to 25% of our monthly throughput at this point in time, the cost of acquiring the customer there is zero because it is borne by our partners, and the cost is already built into the hurdle rate that we get from them. So progressively over a period of time, our cost of acquiring customers is reducing hand over fist. And even when our digital systems launched, we will continue marketing all of these through our channel partner tie-ups with minimal spends on digital marketing or hoardings or whatever else have you, to ensure that this is one piece of our business we keep extremely low and thereby the profitability high.
Sure, thanks. Next question is from Sanket Bihani as a follow-up. So which geographies do we want to focus on primarily?
We're present today in Maharashtra, in the Delhi NCR region, especially in the heavy MSME belts like Faridabad, Ghaziabad, Noida, etc. We have a small branch presence in Gujarat and Rajasthan, and most recently in Madhya Pradesh. I think these are the geographies we'll continue focusing on. We don't want to spread ourselves too thin, dilute the focus of management and our teams by going, pan India. At this point in time, these are the 5 states we'll focus on predominantly, and obviously our digital channel will be more than that.
Okay. Next question from Mithun is, can you talk about the branch level infrastructure for securing gold pledge and what percentage of the loan book would be gold in the near future? Were there any auctioning of gold since the introduction of the product?
Sure. So at a branch level infrastructure, a typical Dhanvarsha experiential center today is about 500 to 550 square feet in size. And I'm glad you asked this question. We should have brought it up earlier. The center looks and feels very different to any other gold loan branch you may have seen in the market today. So each of them will have a small area with a couch and a coffee table waiting area for clients. It's a white, clean look and feel. And the focus is on giving customers in a very low income segment a world-class and premium experience and making them feel important and a very integrated part of our overall growth story. So that's what a Dhanvarsha Experience Center is all about. In terms of staffing, they will typically be staffed by a branch manager. You will have 2 valuers in each unit. So every piece of jewelry, irrespective of the value of the loan, is valued twice. Any loan above 5 lakhs, which are few and far between given our average ticket size, gets valued by an independent third-party valuer as well. And you will have a cashier in the branch too. All the branches are fitted out with state-of-the-art vaults, electronic surveillance systems. So we haven't cut any corners with that. So typical capex of a branch is about 12 to 13 lakh odd rupees, including all of these things. And going forward, as Rohan and I mentioned earlier on the call as well, 50 to 60% of the monthly throughput will come from the gold loan business. As the lab book dwindles down over the period of time, at a portfolio level, we think that gold will cross about 50% of the book in the next 2 odd years. We will continue growing the BL and PL segments, but gold loans are definitely the flagship product for the company going forward.
Thanks, Rohan. Karan. Next question is from Avinash Gupta. It is impressive that the credit cost in MSME is practically nil. Can you highlight verification process of the potential customers, which takes only 30 minutes and still acquire a very good quality of customers?
Sure. So I'll break this down into 2 parts. One is the MSME gold loan, which is the 30-minute product, which is essentially a loan to an MSME customer backed by the collateral of gold, which is done at site in the branch by inspection of the jewelry through 2 valuers and bases a conservative LTV, which effectively works out to about 60% after deduction of the making charges. This gold is practically high quality, normally 20 carat plus. So from that standpoint, I think one point that I forgot to address in the previous question was the auctions. So on an AUM of 700 million plus or 70 crores plus, we barely auctioned about 20-25 lakhs worth of jewelry till date. In each case that we've done an auction, after persistent follow-ups, we've recovered not only principal interest, but all collection charges as well. So that is testament to the LTV being followed. On the core unsecured business loan product, again, the procedures followed are robust. We will have a property owner as mandatory on all of the loan structures there. The TAT is typically about 2 to 3 days to disburse to a client in this case. And we've used provisions of the Arbitration Act effectively to recover money from delinquent customers to ensure that the net NPA in the segment is less than 1% as we speak even today. So our unsecured BL and PL book is actually very, very strong in terms of asset quality. Gold loans being gold loans, again, are secure. The lab book is the only book where we still have some legacy delinquency issues, which are being cleaned up quarter on quarter. And since we became SARFAESI eligible after March 21, we expect significant recovery to happen in the old lab book in the coming 2 quarters.
And Anuj, just to add to that on the credit cost, since the question was also on credit costs, is that we as management and the board made a very prudent call in fiscal 2019, which was right after the INFS crisis, to actually bolster up the loan loss allowance on our balance sheet. So if you look through, we actually added significant amount of loan loss allowance in that fiscal year itself. And even at this point in time, we carry a loan loss allowance of almost 5 crores, which is about just under 4% of our loan book. So we did that as a very prudent measure in that year, given the fact that we foresaw a decline in property prices, especially in the geographies that we were present in, which actually did end up materializing. And as discussed earlier, we have 7 LAP loans that are in the gross NPA bucket. Those 7 LAP loans comprise about 81% of our existing gross NPAs. So if you take those out for the BL and the PL, our gross NPAs are just 0.69%.
Got it. Thank you. Next question is from Mithun. What is the average tenure of the gold loan? Like, I don't know, I think you already covered this if I'm not mistaken, but for his sake, like other players, any plans to introduce doorstep gold loans, online gold loans?
Okay, so the paper tenure of each of these loans is 12 months as per the contract. But from the experience that we've had over the last year, the typical rollover happens in 3 to 4 months. So it goes through a churn of about 3 times in 1 year. And these clientele are guys who keep coming back for gold loans whenever they need short-term liquidity. So they'll open and close the loan as and when they need it. But on paper tenure is 12 months, rollover is typically 4 months. As far as doorstep servicing is concerned, there are some competitors and peers who do that as a structured business. We offer that to clients who may not be able to travel to the branch for any reason whatsoever. But this business is serviced by the branch staff only. So we don't have a separate team or SPU which caters to this. And at this point in time, it's a fairly different business. It's a business of logistics. So we have no plans of getting into this segment at this stage, at least.
Okay, thank you. Once again, a reminder, participants, if you have any questions, please use the Q&A button. I'll ask some of the pre-registered questions in the meantime. So your cost to income ratio has come down from 76.1% in March 21 to 61.5% in June 21. So what was the reason for that, and what are the expectations for financial year 2022?
Sure. So Anuj, we are a young and growing company. In December 2019, we had 46 people on our payroll. At this point in time, we have more than 270 people. I think all of last year, we spent a significant amount of time, money, and bandwidth on increasing our ground presence with the gold loan experiential centers. We also brought in a lot of new people into the company and professionalize and institutionalize the platform further to make it world-class in nature, to be able to cater towards our MSME subsegment. More importantly as well, we spend a lot of money on building out the technology platform, and I think the results of that will be seen going forward with all the effort and the time and money that has been spent. So a combination of all that led to higher cost to income in the last fiscal year, which was fiscal 2021. We're starting to see some fruits of the investments that we put into those various activities bear fruit now, with efficiencies of scale starting to play out, and also higher volume, especially with revenue growth picking up the way it is. We expect that to continue. We would not like to give any formal guidance at this point in time on the cost to income ratio, but needless to say, we're an organization that is very, very focused around profit. So if you notice, we've delivered a profit for the last 3 years. We've also declared a dividend in the last 3 years. Our focus is on profitable growth versus just purely AUM growth.
Great, thanks, Rohan. Another follow-up question on, Jigar Walia has a question. Any levers to variabilize the operating costs? With 2.5 crores loan to break even, how much could be the peak gold loan per branch? Would it be 5 to 6 crores?
So from an AUM standpoint, in fact, just the last week, we had one of our branches finally cross the 5 crore threshold. We have a couple of branches who are already north of 4, and then some in the 3 buckets. So a number of our branches are actually starting to cross these critical milestones. What we are also planning to do as part of our evolution going forward with the infusion of technology as well is to see how we can make each of these branches or experiential centers feeders for our gold loan business, but also our traditional products, including business loan, personal loan, and the distribution or syndication business that we do, wherein we place loans to other financiers as well. How do we stitch up the branches with our franchisee or financial inclusion store partners to be able to feed all of these seamlessly through these units to enhance their on and off book AUM and ensure that they not only generate a fund based income but also a non fund based income at a store level to maximize the profitability and increase the ROA per branch. So that is something that we are working on, and we hope to see fruits of that over the next 2 to 3 quarters.
In addition to that, also, we've recently signed a co-lending relationship with a large bank in India for MSME gold loans. So the idea over here is, while we'll be a minority capital provider, but we will generate economics also on the money that they lend. It actually is a win-win for both entities, given the fact that the hurdle rate that is provided to them is obviously is much larger than their cost of capital, and they don't have any cost of servicing the loan, acquiring the customer, or collecting on that customer. For us, it's a massive win-win because we generate a much higher IRR product on that loan versus what we would do otherwise.
Okay, thank you. Another from the pre-registered questions is the CRAR percentage has jumped significantly on a quarter-on-quarter basis. Do you expect the percentage to remain at the same levels?
The CRAR jumped in the most recent quarter given the equity raise that was concluded in April 2021. We obviously, while you have to maintain a minimum capital adequacy ratio of 15%, we obviously would like to run much north of that. So at this point in time, in the most recent quarter, it was 94%. As we disperse at a fast clip, that will start coming down progressively. But our endeavor is we want to keep it at high levels until we reach a certain size as well. And even after reaching a certain size, it's always good to maintain a very high capital adequacy ratio because it protects you not just from any kind of endogenous risk, but any exogenous risk, which is macro related, which, it's sometimes very hard to predict. So until we reach a certain size, we would like to maintain a capital adequacy ratio of 40+%. And let's hope we get to a certain size, and then we can discuss on this more later.
Sure. Follow-up question from Jigarwalia is, what is the maximum single loan ticket size that we have done for MSME so far?
So MSME gold loans, we've done, I think, a maximum ticket size of about 25 odd lakhs at this point in time. The unsecured business loan that we do, we cap it at 20 lakhs now, for the simple reason that under this segment is where we qualify for priority sector lending, which is how most of our PSU bank loans are structured. So from that perspective, the core unsecured BL is capped at 20 lakhs now. And on the GL side, we've done, I think, 1 or 2 loans to one customer, or maximum of about 25 odd lakhs. But these are exceptions in most cases. The ATS on the gold book is about 120,000 rupees, and on the BL book is about 400,000 rupees at this point in time.
Okay, thank you. Participants, if you have any final questions, please use this opportunity to ask them. One last question from my side, Rohan and Karan, is a question that I'm very curious about is, so how has your experience been working with or having Mr. Peter Collins included in our board, as well as, working with him?
So it's very interesting. We've been following up with Mr. Porter Collins for more than 18 months now, obviously trying to see if he would be interested in investing in a company like ours, and then, trying to see if he would come on as a director onto the board. Having him on the board and as an investor on the company is a big stamp of validation for Dhanvarsha. I think his experience in global financials, having, invested across the globe for over 22 years, and being one of the 5 funds that was featured in the book and the movie, where he himself went and saw empty houses in the state of Florida and how they capitalized on it, being short many of the housing companies in the US. So his acumen in financial services is something we deeply respect. Him joining the board, participating in business discussions in the board, talking about funding, keeping us on our feet on many of the things that we should be aware of as we move towards being more of a digital lender as well, right? Along with being a brick and mortar lender too, adds significant muscle. It also adds significant muscle to the board and, the confidence to the board and towards our lenders on someone like him believing in our story. we personally feel it will also help us significantly with other investors, given the fact that, with him, someone like him coming on, it obviously is with a ton of due diligence that has happened prior to believing in our story.
Yeah, that's definitely quite a feat. Great. I think that covers all the questions that we've had so far. Sorry, there's one follow-up question before we conclude. Mithun is asking, can you elaborate more on Myra and IRA, your source website, like the parameters are considered, etc. How is it helping in eliminating risk and yet help in faster decision making?
Right. So Myra and IRA are essentially internal names that we've given to the alternate data engine that is being built for the MoneyRabbit platform. We managed to build it as a separate plug and play system. So we are actually prototype testing it right now with our old digital lending stack. And by the time MoneyRabbit goes live in November, it will be fully integrated into that. Once the test cases are conclusively proven, we will see how to configure it and integrate it into the new loan origination and management system that we are deploying at this point in time as well. So that is the code name we've given to this alt engine, which has been built in-house. And over the next 2 quarters or so, you will see it in action, not just at a product level with MoneyRabbit, but then integrated into our core LOMS engine to feed on data, which is generated by the GL, PL, and BL businesses as well.
Okay, great. Yeah, I think that concludes all the questions we have for today and the time as well. Thank you, management. Thank you, Rohan. Thank you, Karan. Thank you, Sanjay ji, for your time. And thank you all the participants for joining us today. We really appreciate it.
Thank you, Anuj.
Thank you, Anuj. Thank you to all the participants.
Thank you.
Thank you.